Hi there, back again here with me, Ratli, in Mummy Beluga Investing. This video is a part of Singapore Straits Time Index where I discuss about STA constituent. Today I'm discussing about Singapore Press Holding Limited with stock symbol T39. My quick take for this is that it is a company that's currently being restructured, so much that it seems to move away from their original core business. How I come with this conclusion, stay tuned. Okay, a little disclaimer, this is an amateur video. My main intention is to record my journey learning and practicing investing from scratch. This video shouldn't replace any financial advice and neither suggestion to take a position, buy or sell in the stock market. Please conduct your own research before making any decision. Finally, feel free to put your comments, criticism and suggestions in the comment section below. Okay, let's start with the company profile. Singapore Press Holding Limited, or SPH, was incorporated in 1984. It is currently main board listed. According to SGX website, listing on the main board provides established enterprises with access to the widest range of institutional and retail investors. Companies seeking a listing on the main board must meet the entry criteria, which includes minimum profit and/or market capitalization levels. Okay, as far as I know, SPH core business is in newspapers, magazines, and books publishing in both print and digital. However, as I went a little deeper, it seems that it has moved to properties and REIT. On the property front, SPH owns 66% of SPH REIT, which comprises 3 properties in Singapore. They are Paragon, the Clementi Mall, and the Rail Mall. SPH also owns and operates the Seletar Mall and currently developing an integrated development consisting of the Woodleigh Residences and the Woodleigh Mall. In Australia, SPH REIT holds an 85% stake in Fig Tree Grove Shopping Centre and 50% stake in Westfield Marion Shopping Centre. It is also an owner, manager and developer of a portfolio of purpose-built student accommodation or PBSA in the United Kingdom and Germany. It currently operates 2 distinctive brands, Student Castle and Capital Students. SPH is in the aged care sector in Singapore and Japan and owns Orange Valley, one of Singapore's largest private nursing homes. It also invested in the education and events business. On the 6th of May 2021, a few days ago, Singapore Press Holding Limited, SPH, announced that it will be restructuring its media business by transferring it to a non-profit entity or proposed restructuring. Based on the 2020 annual reports, SPH shareholder is not really transparent. From this list here we have on our screen, we can see that the top 10 holders seem to be behind some custodian account. Interestingly, juicy part, NTU and NUS hold 4.02% each of the management's shares. This is the first time that I see educational institution holding shares of a public company. Management share in Singapore context is different from ordinary share. Typically, management has more voting rights. For SPH, management shareholders has 200 times more voting rights for the case of director appointment and staff related, while ordinary shareholders only has 1 vote per share. Okay, so that was a short profile of Singapore Press Holding Limited. Now let's take a look at the company's performance. To look at the company's performance, as usual, I will look at their earnings first. This works well for public company. It is my first indicator to see whether the company is stalling or growing. It also helps me to decouple the company's performance from market sentiments. So here I plot SPH earning per share over the last 14 years. Let's look at the screen. The data is plotted as round red markers connected with thick red lines. I've also included a horizontal dashed green line to indicate level 0. Earning below 0 means that the company is recording a loss. Okay, quickly we can see that so far SPH earnings have been in decline for the last 14 years, which finally record a loss for the first time in 2020. The 2020 annual report mentioned that the net loss attributable to shareholders was 83.7 million, largely due to a non-cash 232 million decline in valuation of investment properties as a result of the impact of COVID. This is based on the annual report. The companies acknowledged that Job Support Scheme, or JSS, granted by the government of Singapore had helped them to cushion some COVID-19 fallout. Okay, that was SPH earning performance. Now let's take a look at what are the perks for the shareholder, which is the dividend. So here I plot SPH dividends for the last 12 years since 2009. The dividends data are plotted as red round markers connected by a thick red line. Each of the markers have been annotated with two numbers. The numbers above the markers are the dividend in dollar amount. The numbers below are the payout ratio with respect to the earnings. As a comparison, I've plotted the earnings as a thinner red lines here. Generally, for the past 12 years, SPH dividend payouts are reasonable, which are around 60% of the earnings, except a spike in 2013. Okay, 2020 dividend payout is also special because though it's recorded a loss, it still paid out some dividend. It is clear that since the earnings have been consistently in decline, so as the dividends. Okay, so that's the perks for the shareholders, the dividends. Now let's see whether SPH is still traded at a reasonable price. So to see whether SPH share price is still reasonable, here I plot 3 layers of information. One of them is the market data and 3 from the fundamental indicators. Now let's go through them one at a time. The first information that I plot is the price. I plotted the price since 2009. For the last 10 years, SPH price has a downtrend. This information is highly available and the most quoted, but most of the time doesn't really correlate with the company's performance. Hence, I'll add one of the fundamental indicator, that is the earning multiplier, or sometimes called the PE ratio. Here I plot the 10 earning multiplier as the green dashed line. Normally, for mature company, I will consider the fair value if the stock price is below this green dashed line. Okay, for the last 10 years, SPH earnings have been declining, and so does the share price. We can see the clear pattern here. The next layer of indicator is the 15 times earning multiplier. I'll consider the stock price to be really expensive if it goes above 15 times earning multiplier. Finally, the 20 times earning multiplier. I consider the stock to be super expensive if it goes above this line. Okay, now we have the necessary indicators to decide the reasonable price. Let's discuss what's going on with SPH share price. We can see quickly that the market response is proportional to SPH earnings. The share price decreases in line with its earnings so far, based on the data that we have in this graph. A brief recovery happened in the early 2021, which seemed to drop again, unfortunately, after the 6th May announcement. Okay, in my opinion, SPH is not a growth company. Okay, to decide the reasonable price, typically I'll take the price at PE10 or lower. But since SPH recorded a loss in 2020, and since there is no such things as negative price, so I'll take the 2019 earnings to decide what seems to be a reasonable price for SPH. Okay, that put SPH reasonable price at $1.3 per share from fundamental perspective. However, from the direction of its transformation, I still don't feel comfortable with those fundamental value. Hence, I won't be considering to make any position in SPH. Okay, so my conclusion for SPH are, it is a transforming company, but the transformation doesn't seem to be an innovation based. I may be wrong, but we'll see. Okay, thus doesn't have a positive long-term outlook for me, at least so far based on information that I have at the moment. Fundamentally, it seems to be a declining company, so I will not make any position. Okay, that's all my video on SPH. I hope my analysis is useful, and I'll see you in the next video. Bye.